Hello and welcome to this week's Gig Harbor Market Update. My name is Christian. We're going to be talking about interest rates and specifically mortgages and how expensive they've gotten recently. So we're going to be talking about if there's any clever ways that we can reduce our monthly payments. But before we get into the meat of things, I'd like to bring up an article that I ran across that kind of sparked this whole idea that I want to be talking about today. Let me get into it right now. Let me pull it on the screen. Okay, here we go. This is called, I'll link this article in the description down below. You're welcome to read it to yourself. Basically, it's called CoreLogic and KPMG Make Bold Housing Market Calls. Basically, here, I'll not have to read the whole headline, but let's talk about something here where it says, in the bullish camp, you'll find CoreLogic, the real estate research firm that expects U.S. home prices to rise 3% between December 2022 and December 2023. So that's 3% essentially this year. On the other hand, you have, well, I guess in the bearish camp, you have KPMG, which is one of the big four accounting firms, and they expect U.S. home prices to fall, as well as measured by the Case-Shiller Index, to fall by 8% this year. And if we scroll down below, we can see this in graphic form here. Basically, this red line represents where CoreLogic expects the housing prices to end up by the end of 2023, and the blue line is where KPMG, who expects home prices drop by 8%, expects home prices to be here, and this on the left is the median house price in the US. Of course, Gig Harbor is on average much more expensive than the average home price in the US. So we're going to be talking about what that means for people looking to buy homes in Gig Harbor. Sorry if I rushed through that real quick, but it was just there to highlight that an 8% drop, even in like our worst case scenario, isn't that much, especially when it comes to the median home price in the US. Now, if we look at median home prices here in Gig Harbor, let me pull that up on the screen here, we can see that in December, our median home price was around $730,000. So these are for residential, previously owned houses, not new construction. Basically $730,000. So if we can expect another 8% drop from $730,000, we'd be looking at about $671,000. So 671, and that's we're essentially halfway there when it comes from $730,000 of December to where we are now, which is now $700,000. So we can expect another 50% drop, which is about $30,000. So if if housing prices were to drop another $30,000 here by the end of December, what kind of interest rates are we going to be looking at, and what kind of home prices and what kind of debt service we're going to be looking at, and are there any ways around this? Because when you start crunching in the numbers, it's pretty painful in order to afford a house in Gig Harbor. So let me see if there's any ways that we can use some interesting financial creative ways to reduce your monthly payments. And this drop is only assuming that KPMG is right. I mean, if CoreLogic turns out to be right, I mean, the price is only going to go up from here. So might as well start thinking about ways we can get into the Gig Harbor market now. Otherwise, we can wait a little bit, but still be, talking to a lender to make sure that we're all on the same page. Okay, let's start into by giving an example here. I'm going to pull up on the screen. Okay, first example, here's what I put into my email. So I'm going to just put it on the screen here so we can both look at the same numbers. Basically, what KPMG is predicting is they're expecting houses to come down. And why would housing prices come down? Is because the Fed and the rest of the interest rates kind of pushing their way through the economy. And especially if the Fed raises rates again by 50 basis points here in another week from now. So we're going to see what's going to happen to our interest rates, especially mortgage interest rates. But let's assume mortgage interest rates do go up, and therefore housing prices come down. Let's say they come down to the prediction of 671, as we talked about earlier, and let's see what would happen to our mortgage rates. So we're going to assume here is the median price house in Gig Harbor, nothing fancy, okay? We're assuming a 20% down payment because talking about PMI kind of throws things into a, let's just talk apples to apples and oranges to oranges. So basically your down payment that you're looking at is $132,000 as a 20% down payment. And if we assume interest rates to go up or just even kind of level out here, we're talking about a 7% interest rate. So what does that mean for your monthly pity payments? And I didn't say mortgage payments, I said pity payments, because mortgage payments really take everything together. So you got principal, interest, taxes, and insurance. So that's everything kind of wrapped up together. And you're looking around $4,500 per month that you have to pay towards your pity payments. This in turn means that you're paying $54,000 a year on just housing costs alone. I'm not talking about any maintenance or hiring a plumber to fix a bathroom or something. Now this is just paying the bank, paying the insurance company, and paying the tax man. So if you have a 50% DTI, which is the maximum debt you can have that a bank is going to allow you to have, and this means you are carrying no debt whatsoever, no student loans, no car payments, no credit card debt, no nothing. I'm talking about, you're free and clear. All you have is a mortgage. You have to be making as a household $108,000. And we can play around in the Nerd Wallet affordability calculator here in a second, but basically let's just use it as a number that a household has to be making that much money to essentially afford a house that we just talked about, the median sales price house. Actually, because this is email and I didn't want to really digress too far, but this is a video now here. So we can actually play around with the Nerd Wallet affordability calculator, and we're just gonna plug it in here. We're gonna say how much can we afford in Gig Harbor, and we can add some things. We can change our credit scores here. We can change, let's say, loan details. We can edit rate. We're gonna assume just a 7% rate here. We're gonna say our down payment is 20%. We're gonna say our loan term is 30 years. We're gonna say veteran no. And then we're gonna say our household income is 108 and our monthly debt is 0. Now you can play around with your own debt. You can say it's $1,000 a month and you can see how quickly that changes how much house you can afford. But then again, you do have a slider, and this is a DTI slider, which is debt to income. And basically this is the maximum amount that the bank will allow you to have, which is 50%. And what is commonly known as the affordable DTI, which is 30%, 36% DTI, that's here in the green. And now the question is, can you really afford it? You're making $108,000 and you can afford essentially a mobile home in Gig Harbor or up north. So let's put this back to aggressive. So this is what I was talking to you about. Let's get rid of this debt real quick because that impacts. So if there's anything you should take away from this is reduce your debt because it allows you to afford a lot more house. Okay, 7% household income at 108. Okay, let's go back. Let's stretch this budget to all the way up. And we're looking at around, the median priced house. And of course, those things are going to change because Nerd Wallet does not include actual property taxes or homeowners insurance. So let's say we're paying $113 in homeowners insurance, and our property taxes are, let's say let's say $650. And so you can see our mortgage payment, which is our pity payment, and then if there's any HOA, you gotta include in that. And because we're paying 20%, we don't have a PMI. So this is a good way to quickly check with your current household income, with your current household debt, how much house you can afford and how much of your monthly payment you're gonna be looking at for your pity payments. And this is at 50% DTI. So that's a good way to kind of crunch those numbers and see, can I actually afford a 30-year fixed rate at our current interest rates? If you can't, then this video is perfect for you because we're looking at some different mortgage options available to you and to kind of combat this high interest environment. Before we get here into the more nuanced approach of how to afford more house in Gig Harbor, let's go over some of the generic stuff. I don't know if you've already been doing it, but this is the advice that every website's going to give you, or every every financial advisor. They're going to say, well, you should improve your credit score because a higher credit score means that you're going to actually be charged less interest by the bank because you're seen as a less risky investment on their side. So the higher credit score you have, the more they can rely that you're going to pay them back. You can also look for a cheaper home. Yes, a cheaper home means less housing payments or housing expenses, really. Wow, incredible, right? You can also look by putting it towards a larger down payment. However, we saw already for the median price house in Gig Harbor, that's already $132,000. So by asking for a larger down payment doesn't quite make sense in the median price house. It makes maybe more sense if you're looking at maybe a $400,000 house. And yes, a larger down payment would make a big difference in the fact that you owe less money to the bank because you borrow less from them. You can also start reducing your debt, which means paying off any high interest debt immediately. That way you don't essentially just burn through your cash. This will allow you to not only have less debt when you go to a mortgage loan officer or a mortgage broker, and they're gonna say, oh, you can afford more house because you don't have any debt. And you can play around that again with the Nerd Wallet affordability calculator and see how much exactly $1 of debt means towards how much value of a house you can get for just $1 of debt you pay off. It blows your mind. I'll let you find that out by yourself. It's incredible. The last thing you can do is, of course, put at least 20% down to avoid a PMI, but not everybody has the luxury of putting 20% down for a house. But that's just the generic advice that I should give you and that everybody else was going to give you too. All right, without much further ado, we're going to be talking about how to buy a house in a high interest rate environment with some more interesting mortgage techniques here. And I'll switch over the screen. Sorry for this big thing. Basically what I want to talk about is our first option is an ARM. Our second is a 2-in-1 Buydown, and the last option is a piggyback loan. Those are, I know they sound funny, we're going to get into them here individually, but those are the three options that we can look at. All right, our first loan instrument is called an ARM, or adjustable rate mortgage, and it sounds kind of like what it means. If you don't know, well, here's the detail. Not too long ago, I was adamant against taking any sort of adjustable rate mortgages because mortgage rates were stupid low. I mean, you can get a fixed rate mortgage under 3%. I would never ever suggest that rates would actually go down and that you were actually missing out on even a better rate. I would say just get the fixed rate and call it a day. However, now that we've gone into an incredibly high interest rate environment here, and I don't think they're going to go too much higher. They might tick up another 0.5% or so, but I don't think we're going to go to the 18% like during the Paul Volcker era of the 1980s. So I think that's why there's now a case to consider an ARM. So besides the fact that your mortgage rate can adjust after a certain amount of time period, which we're going to talk about here in a moment, basically after that set amount of time, your mortgage rate will automatically adjust by a certain amount of percentage. It's capped to how much it can fluctuate every 6 months or every year. Okay, besides that, what you should know about an ARM is that there are lower payments for the first several years of the loan. If we can expect rates to slow down towards over the next 3 to 5 years, I don't expect rates to continue to go up. They're going to probably taper off here. So an ARM should be relatively safe. Then our monthly interest payments would actually start to decline, and however, it's kind of hard to say because every ARM is structured a little bit different, but we'll get into that. Okay, so basically by taking ARM, you have a lower interest rate up front. The second thing is there's no need to refinance because, to get a better loan, because I don't see interest rates coming down that quickly. But basically, this loan will auto adjust itself downwards, so you're always getting the best rate, essentially. And that's not always the case. Trust me, if you're expecting interest rates to rise, you should not take an ARM. Okay. Also, a good benefit is if you're a frequent mover. Basically, you can lock in a low interest payment for 10, 7, 5, or even as low as 3 years. So we can look at this here in a second. Here we got our ARM mortgage calculator. So here you can see that we have a 10-in-1 ARM, 7-in-1, and then so these first numbers are the length. So a fixed interest rate for 60 months, in this case of a 5-in-1 ARM. Then it adjusts every 1 year. Or you can get a 6-month ARM, which adjusts itself every 6 months. And that probably is the best thing to do right now, is probably 6 months. Again, I'm not a financial advisor. I would talk to your mortgage guy or gal, or talk to your financial advisor to see what they think is best. But basically I see, our interest rates coming down, so it's updating every 6 months. Is probably the way to go to keep up with the lowest interest rate. But there's pretty much explained. And then you can plug in some numbers. Here we have 671 over 30 years. Our initial interest rate is 5% or whatever have you. Again, with the current interest rate being 7%. So this is a reduced interest rate. And then you go look at, okay, how many months before an adjustment? In this case, 5 years. Months between adjustment, we can do as low as 6. And if we expect interest rates to continue to go down every adjustment, I think a 0.25% is probably pretty safe every 12 years. We can do half of that. That's not quite half. And then interest rate cap is basically how high as it can go. And you're looking at mortgage payments continue to come down as you pay off your loan. So that's a real great way of taking advantage of this type of loan instrument when we're probably at the peak of our interest rate cycle. Now, an ARM is not risk-free. There is always the risk that the Fed might do something stupid and do a Paul Volcker, which means bumping up interest rates up to like 18%. And of course, if you have a 10-year ARM, you're not going to be facing an 18% interest rate, especially the fact that you're capping yourself at a certain percentage increase every year. Now, if they do somehow fluctuate to 18%, they are trending upwards, let's say, you can always just either sell your house, or you can always refinance into a fixed rate loan. So if you're completely risk adverse, like you don't want any risk in your life, then just settle for the 30-year fixed rate mortgage. But if you think that you can take advantage of the fact that we're probably at the peak here of interest rates, then this might be a good way for you to hedge your bets, take a little bit of risk, and get rewarded in the end, perhaps. So that's basically it. And those are the pros and cons of the ARM. The pros are you can actually pay less in the future, or the con is you can pay more in the future in case interest rates go up, in case the Fed has to do something crazy and there's a completely economic overhaul and everything goes to hell in a handbasket. So that's the risk, that's the reward. Now let's talk about our next loan instrument. This is the 2-in-1 Buydown. Basically, it's you pay a little bit up front in order to reduce the amount of interest you have to pay for the first and second year. There are ways that you can do discount points and actually buy down the interest rate altogether on the life of your loan, but those can be pretty expensive. So if you're already trying to scrimp enough cash together, this is probably going to be up more your alley. So we can first look at what is a 2-in-1 Buydown. There's a great website that explores it here in detail. That goes pros and cons, when to use, explore options. Okay, basically what I gather from this is that the first year you get a 2% reduction on the interest rate. So if interest rates are 7%, now you get a 5% interest rate for your first year. And then your second year, that bumps up by 1%, so you're now looking at a 6% interest rate. And at year 3, you're back at the initial interest rate of your mortgage. So in this case, hypothetically, 7%. Sorry if I'm going a little bit too fast. I am kind of in a hurry, so I do have to rush this along. I won't even spend much time on editing because I'm such in a rush. So let's just get into this third one really quickly. It's called the Piggyback loan, and it was pretty common, I would say, in just after the crash, after 2008, 2009, and it was used as a way for those people that didn't quite have the 20% down to avoid PMI. So let's just look at how that is structured. Oh, okay, well, I don't need my face. Basically, a piggyback loan is it's called also an 80-10-10 loan. It also comes in different weights, as we'll look at down a little bit further. But let's just read the description, what Mortgage Reports describes it as. So basically, a piggyback loan combines two separate loans: a larger first mortgage, which is your typically like 30-year fixed rate mortgage, and a smaller second mortgage, usually a HELOC, to help buy you a home more affordably. The second mortgage acts as part of your down payment. So it goes into here. When you make a 10% cash down payment and then take out a 10% second mortgage, you're effectively putting down 20%. So you got 10% cash and then 10% in the form of a HELOC, plus your 80% in the form of a 30-year fixed. That is the 100% value of the house. So this leads to lower interest rates and no private mortgage insurance. So you're wondering, why do I want to avoid private mortgage insurance, and why do I want to risk a HELOC? Well, I'm glad you asked, because there is a calculator we can use here in a second that'll give us some numbers to play with to see which one is more affordable. Sometimes the PMI, which is a private mortgage insurance, is best for us, and sometimes the HELOC payments are the best for us. And there's also a couple of different options. You don't have to go with the 80-10-10. It can go 80-15-5 or 80-5-15. Or with this one right now is very common for people looking to avoid jumbo loans, which basically a jumbo loan is you ask for a lot of money from the bank, and that's a lot of risk for the bank to take on, so they're going to charge you more for it. And for I think it's like a 40-year or something like that loan. So some people want to avoid the jumbo loan. So basically you can structure it to be a 75-15-10. So we have this piggyback loan calculator. This is my email. Well, I just can pull it up right here. I'll also link it in the description. This is not the calculator, sorry. This is the calculator. So basically I put down the price of our home. I said we're going to do an 80-10-10. Let's just do $5,000 in property taxes. Insurance is maybe $1,000, let's say. Optional, okay. So here we can compare. Let me zoom in a little bit. Sorry about that. Our loan amount, okay, our down payment amount is the same. Here you can see that our first loan and second loan get broken down into two. Here's our down payment percent. In either case, we're stuck with the 10%, right? We don't have the option for the 20%. So we can see a loan term of 30 years. Interest rate, let's say this is the future now, 7%. Our annual PMI, and you're looking here at a PMI rate of this, together with monthly property taxes, insurance, and our total monthly payment of $4,769. Now if you did a piggyback loan, we can see that there's some customizable things here, but basically this is your loan year for either loan and our interest rates. HELOCs tend to be higher in interest rates, so that's just something why it says 8% instead of 7%. Here your PMI is 0, but instead of that you have your HELOC that you have to pay off monthly. Here's almost $500, but in exchange we have a reduced first loan of that's now $3,571. Combined, you're actually saving around $200 each month on a loan. I know it's not much, but you can also change it. Perhaps you have 15% down. You don't quite have the 20%, but here you can see I just changed it. Basically, we were doing a 5% HELOC here and 50% down, and our monthly payment actually went down by $430. Or I can't even see. It says $450. So that's quite substantial now. And of course, if you don't have, maybe you just have 5% down. Let's look what happens. Oh, look at that. Our HELOC now costs more than our PMI. So if this is our case, it's probably the best course than just to take the PMI and just, pay it off as quick as possible. And in order to do that, in order to do that, you have to just keep paying off your mortgage until you have 20% equity. Normally, the bank is supposed to cancel the PMI as soon as you get to the 20%, but you probably will have to tell them they don't like to cancel anything. But that gets us to the next point of why a HELOC is sometimes beneficial. Now, let's talk about the HELOC here. There is a great guide here. It says, what is a piggyback mortgage? Basically, it goes through everything in much more depth than I covered. So they go through, how to get a loan, types of piggyback loans, can avoid jumbo loans, there it is. Financial planning, why even consider a HELOC? Because it's like a credit card in your house with lower interest rates. And then refinancing. So refinancing is a little bit trickier when you have a second mortgage on your house. But with a HELOC, the good thing about it, unlike a PMI, is you can pay off a HELOC in, like, let's say 3 years. So let's say you have that $67,000 HELOC and you manage to put $22,000 towards it additionally on top of, well, not on top of, but this is disregarding your first mortgage. Let's say you're just paying off your second mortgage, the HELOC. Let's say you pay off the $22,000 a year on that. You can pay that off as quick as you want or as slow as you want. You don't have any prepayment penalties. And actually a lot of mortgages have prepayment penalties because the lender doesn't want you to pay off the loan quicker because they want to collect interest on you. So if you pay them off quicker, the amount of interest they collect is actually lower. So that's why they like to penalize you. But basically you can pay this HELOC immediately and that's it. Nobody's asking any questions. It's essentially just paying back your credit card. It's essentially the same thing. So that's one good thing is you can essentially get rid of your PMI in the form of your HELOC, as quick as you can manage it. And the last thing I'll say on this subject is the piggyback loan can be very popular with investors, especially if you're looking to buy, of course, an investment property. Now, if you're buying an investment property, the bank will make you put down 20%. But what happens if you don't have 20% to put down? Now that's where the piggyback loan comes in handy. Let's say you only have 10% down, but you have enough cash flow, but you don't have, you can't wait 10 years in order for you to get that $130,000, let's say, but you have enough cash flow to pay off the HELOC slowly, there it is. Then you can essentially get your 20% that the bank requires for your down payment for an investment property. And you don't have to pay all that money up front. So it's a great option for investors. So that's it. And that was a whirlwind tour of various loan options or mortgage instruments or whatever it calls you. Hopefully that'll help you maybe reduce your payments in Gig Harbor, or qualify for a house that you like that's not falling off the cliff, and take advantage as more people drop out of the buyer's market here, it means you have far less competition when it comes to buying a house. You no longer have to, give the seller the option to name your firstborn kid, or to send them on vacation, or put $200,000 on top of the asking price, which did happen. All of those things did happen. So anyway, I hope you enjoy this. If you did, please subscribe, give me a thumbs up, and if you'd like to work with me, again, Christian, I don't know if I said it again, but anyway, I said it to myself. My name's Christian. I'm a Windermere agent here in Gig Harbor. You can reach out to me anytime you want. My contact information is down in the description below, and I will see you next week.